Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, China's internet watchdog tells Alibaba, ByteDance and others to terminate orders for an Nvidia AI chip.
Plus, Microsoft OpenAI among the tech giants announcing plans to spend tens of billions on AI infrastructure in the UK amid President Trump's visit this week.
And ticket reseller StubHub begins trading publicly today. We'll be joined by its CEO, Eric Baker, live from the NYSE.
Meanwhile, let's get to the rest of the public markets. Ed, we're in wait-and-see mode. Maybe a bit of profit-taking after what's been a significant run-up in the Nasdaq of late. We're down about 0.5% on the Nasdaq 100 as we anticipate a Fed rate cut that is being priced in by the market. But what does it signal for the rest of the year? That's a key question on the macro side. What have you got on the micro?
Well, a big part of the drag at the index level is Nvidia. We're down almost 3% on a $4 trillion market cap company, down for a third straight session. $200 billion in market cap loss. The headline's really simple. The FT reporting that China's internet regulator is saying to big Chinese tech companies, cancel orders for the latest D-powered variant of Nvidia's AI chip for that market. At the same time, Jensen Huang's in London with the President of the United States in the UK on that state visit. There's a lot of focus on this name right now.
There certainly is. Let's get to it over in Washington. Our tech editor is with us, Mike Shepard. Look, this is going to be a key conversation that Jensen Huang is likely to be having with the President of the United States, because once again, another chip designed for China being pushed back by the country itself.
Well, that's right, Caro. And Jensen Huang has been having those kinds of conversations with President Donald Trump since he took office in January. Jensen has been trying to reshape the picture when it comes to export controls in a way that's a little bit more advantageous for Nvidia. Over the past several years, we've seen the U.S. tighten China's access to Nvidia's most advanced AI chips, and they just won back permission to sell the H20 in China, although now we are seeing China balk at that. This latest turn of events, though, signals an escalating pressure campaign by China, and they feel like they have some leverage there because the local companies in China making semiconductors can now compete with some of those lower grade, lower performance AI chips from Nvidia. And now Nvidia would like to leapfrog that and sell something perhaps a little more advanced. But they would need President Donald Trump to get aboard with that. So we'll have to be watching not only for whatever conversation takes place between Jensen Huang and President Trump, but the more important conversation on Friday, Caro, between Trump and his Chinese counterpart, Xi Jinping, to resolve a host of issues. We know about TikTok, but now Nvidia is really emerging on the screen as a topic that they will discuss. China has expressed a lot of chagrin over export controls, and this would be a moment to settle it all, including for Nvidia.
And to be clear, the chip in question here is RTX Pro 6000D, not H20, which is largely Blackwell architecture related and doesn't use HBM. And we're trying to get more on that story. Bloomberg's Mike Shepard, thank you very much. Microsoft, OpenAI, and other American companies announced plans to spend tens of billions of dollars on tech infrastructure in the UK, from AI to quantum computing. Other announcements include investments from companies like Nvidia, CoreWeave, Salesforce, and Google. This comes as President Trump is in the UK this week. Bloomberg Surveillance's Anne-Marie Hordan joins us from Windsor. The headlines are really clear. Capital commitments from the biggest technology names, but they are like attending this state visit with Trump almost in parallel, AMH. What do we need to know, and what happens in the next couple of days?
Well, it's tens of billions of dollars, as you've said, when it comes to a massive dump of capital from these U.S. tech firms into the United Kingdom. Massive win for the Prime Minister, Keir Starmer, especially at a time when he's dealing with a lot of political fallout here in the United Kingdom, really drowning in the polls and has been on thin ice. We've seen a number of individuals resigned or ousted from his government, most notably Lord Mandelson, after revelations of his close relationship with Jeffrey Epstein in Bloomberg News reporting. So this idea that UK tech firms want to make sure that they are in the United Kingdom and building the United Kingdom is definitely a win for the Prime Minister. You have to think, though, that given all of this money that is coming from the United States, regarding artificial intelligence, regarding cloud computing and quantum computing into the United Kingdom that might give the president some wiggle room and leverage to feel emboldened to bring up once again at the negotiating table the digital services tax, which more than 20 Republicans in Washington are really urging the White House to do on this trip. So there's a lot of tech deals to be had, and this evening the president at a banquet is going to be flanked by Jensen Huang, who is of course with him as well on the Middle East trip, Sam Altman of Altman AI, Satya Nadella of Microsoft, and also I think the name to watch, of course, is Apple's Tim Cook, because notably that was the individual that was missing in the Middle East that the president continuously wanted to remind everyone he was absent. He's joining him on this state visit to the United Kingdom.
Bloomberg's Anne-Marie Horden, we thank you so much from Windsor Castle. Let's talk more about TikTok now, because its US operations would be acquired by a consortium that includes Oracle, Andreessen Horowitz, and a private equity firm, Silver Lake, under a deal President Trump is set to discuss with Chinese President Xi Jinping this week. This framework agreement would create a US-based version of the popular social media app. Let's bring in Bloomberg social media reporter Alexandra Levine. I mean, this whole segment is about how technology is at the heart of geopolitics. TikTok has been throughout many a year. Does it feel like we're getting some semblance of that framework that still might not actually occur?
Well, look, the issue has never been, can the U.S. come up with buyers that China likes? The issue has really been, can China part with the algorithm, which is the secret sauce of TikTok, which is what makes it so popular with half of the country. And so even though we now know that Oracle and Silver Lake and Andreessen are sort of potentially at the finish line with this, there's very little detail about how ByteDance will be involved in this potential U.S. app that U.S. users might be asked to migrate to. And so without knowing the details around the algorithm and also ByteDance's involvement, we really don't know if what we will end up seeing with this framework will even be compliant with the law.
Exactly so. Everything we're discussing is according to Bloomberg reporting and Bloomberg sources. And when we did speak to a White House official, they basically said that any details of this framework are speculation until such time that the White House confirms them. However, based on the reporting, Alex, something Caroline and I were discussing this morning is that the consumer, the TikTok user, will face a choice. Go to a new app, stay or not, and just explain the kind of no man's land and confusion there is out there right now for TikTok as a platform.
Well, look, I think that TikTok users have proven that they are an extremely loyal base. We saw that earlier this year when TikTok was on the verge, or last year when TikTok was on the verge of being banned, and TikTokers called their members of Congress and deluged them with messages saying, keep the app, don't ban the app. But I think one thing that'll be really important to watch is just the limbo that the people working at the company will be in, and also a lot can change between now and Friday. As we know, there's a lot going on with Nvidia right now. There's sort of other players that are percolating in the background that could completely change things between now and Friday, and then a lot could change between Friday and the middle of December when this next phase of the extension will expire.
Bloomberg's Alexandra Levine, thank you very much. Now, coming up on Bloomberg Tech, shares of the ticket reseller StubHub begin trading today. Stick with us for a front row seat to a conversation with CEO Eric Baker. No ticket required. That's next. This is Bloomberg Tech.
Shares of StubHub will start trading today, with the shares having been priced at $23.50. That values the company at around $8.6 billion. The ticket reseller is the latest company to go public in a US IPO market, experienced a bit of a hot streak. Let's speak with StubHub CEO Eric Baker, who joins us now from the NYSE. Eric, the history. You set up this company in the year 2000, you sold it to eBay, bought it back, amalgamated with a European giant you had already built, and now it goes public. How does it feel?
It's tremendous. A lot of gratitude to reach this milestone for the company. It's certainly been a long journey, as you say, from 2000, but now we're really focused on the next 25 years and the bright future ahead.
Take us to the next 25 years, because there are regulatory headwinds. There are people worrying about bots. There are a way in which you can beef up this business to add more things in secondary market ticket sales. Where do you go? Where do you focus?
Yeah, so our focus really is we've always wanted to make it easier for people to access live events. And so what we started with is, as you noted many years ago, was to make the resale market safe and secure and easy for people to access tickets. What we're focused on now is we realize consumers don't care whether it's a primary ticket or a secondary ticket. They just want to access the live events that they want to go to and discover easily, safely, and so forth. And that system's been pretty broken for a long time, how those tickets are originally distributed. So we're really working on creating a better experience, and we've already had exciting partners like the Yankees and Major League Baseball who started selling tickets directly in this open distribution network.
You looked at going public in a time where Taylor Swift had gone through the Eras tour. There was a lot of hype and momentum, and you hit pause. You're doing it now, and I think a big question everyone's got for you, Eric, whether they're a consumer or not, is what happens next with a regulatory crackdown. The practices of your industry are very much under the microscope at the moment.
Well, I think, first of all, we're always excited to be at the intersection of technology and live events because we're very bullish on the future of live events, and we think that doesn't change. To your question about regulatory focus, I think two of the things really people have looked at, one was transparency in pricing. That we at StubHub have always advocated for. And that all-in pricing that we lobbied for passed at the federal level in May. And that's just a better experience for consumers. And the key is it's now a level playing field for everyone in the market. I think the second real regulatory focus, quite frankly, has been what the Justice Department is looking at with the primary issuance of tickets and making sure that networks are open and fan-friendly. And that is something we certainly applaud because we're on the side of the fan.
Eric, is artificial intelligence a headwind or a tailwind for the secondary ticketing market?
Yeah, we see it as a tremendous opportunity and a tremendous tailwind. And I think if you think about it, again, we're a technology and product company. And I think Alex Karp at Palantir, I don't want to misattribute, put it really well that he said the artificial intelligence technology for companies that have tremendous data allows you to provide a better product while increasing your revenue tremendously and reducing costs so that everyone wins. And we're seeing that across the board, how we deal with customer service, how we're releasing new features in the product to make it easier for people to locate the tickets they want. So we're very excited about it. And again, with the leadership position we have and the scaled proprietary data we have, we think the sky's the limit.
We are speaking with Eric Baker, founder, CEO of StubHub, to our radio and TV audiences. You say AI could help drive revenue tremendously. Let's talk about your revenue thus far, because in the first half of the year is about 3% growth. That is significantly slower than the previous. Now, we know that maybe we haven't had Taylor Swift on tour this year. But Eric, are you seeing a slowdown in demand?
Yeah, so thank you. No, we're really seeing people continuing to buy tickets and growth. I think it's important to note two of the things that happened that are unique this year. One is Taylor Swift, and her tour is behind us, and there is only one Taylor Swift. So I think she's so tremendous, we even broke her out in the S1, so it's great to be that popular. Second is, as I mentioned, all-in pricing passed in May, and when we lobbied for it, we knew that creates a one-time hit to the market as consumers just adjust. We've seen that already in states like New York that had passed it before. So when you look through those headwinds, the business is growing extremely nicely, north of 20%.
I'm interested, though, on your profitability or lack thereof, Eric, because it's interesting you've gone public without that story to tell. When will it become the story you can tell?
Yeah, no, I think what you're referring to is by the accounting metrics like net income, that it shows a loss. But I think when we went on the roadshow and when investors look, they really look at EBITDA, which is your earnings before interest, tax, depreciation, amortization, as well as your cash flow. And on that dimension, we've been profitable for a long time and generating hundreds of millions of dollars. That's the way we've been able to service the debt that we've had. And obviously now that we're deleveraging and taking the debt down, our cash flow will even go up further. So I think that's one of the many reasons that our story was very well received when we went out on the roadshow and by our new partners.
Eric, Bloomberg did some deep reporting on the FTC looking at Ticketmaster Arrival on the issue of bots hoovering up tickets for resale and their inaction. Have you discussed that issue with the regulator, and how are you addressing the problem?
Yes, we've always, and bots, and it's interesting as you note, is really about how these tickets are distributed in the first place. And so one of the things we've always lobbied for is enforcement of the Bots Act. And that's really because we believe that these tickets need to be distributed in a way that's safe, secure, democratic, through open channels. As you mentioned, they're looking at, I believe, Ticketmaster and others who are handling the primary issuance of the tickets, and they really need to make sure that their technology and safeguards are in place to make sure this doesn't happen. But again, it's something that we're very pro-consumer. That's how we win. So we hope that all that stuff gets cleaned up.
Eric, very quickly, next year's soccer or football World Cup, how big an opportunity is that for StubHub?
Look, we love the World Cup. It's been a phenomenal event, because think about it, we run the largest global platform in the world for ticket exchange, for all kinds of events. And if you had to say what is the largest global event in the world, I think you can honestly say it's the World Cup. It's people from all over the world traveling to come see events. It's going to be in North America. It's extremely exciting, and we're excited to hopefully help as many fans as possible make their dreams come true to access getting to the World Cup. So we're all football fans, so to speak, in 2026.
We're football fans here too. Eric Baker, founder and CEO of StubHub Holdings. Great to have you on the program. Thank you. Now, coming up, we're going to be joined by Groq CEO, that's Groq with a Q, Jonathan Ross, on the company's new funding and its plans to expand data center capacity. This is Bloomberg Tech. Compute provider Groq just closed a new $750 million funding round, valuing the company at $6.9 billion, highlighting investor interest in companies seeking to alleviate a shortage of chips and computing power for AI workloads. Groq CEO Jonathan Ross is with us. And I always like to go back to basics with you, Jonathan. Like, Groq stacks up against Nvidia and Google's TPU, and we're largely focused on inference. Why did you raise this round in that context? What is it going to allow you to do to be more competitive against those two giants?
Well, the bottom line is that the demand for inference is insatiable. The total amount of capacity that people are trying to deploy is mind-boggling, the numbers that people are putting up, and that's only growing. And in our case, we don't feel that we're competitive, we feel that we're differentiated. If you're not differentiated, there's no point. And in our case, what we're able to do is we're able to provide price performance. So when you're training these models, you don't need the chips to run particularly fast. You just need them to have a lot of throughput. In our case, we're able to provide both speed and throughput, lowering the cost. And when you're spending money on every single query, the difference in that cost can be the difference between profitability and losing money.
Inference meaning running the models as opposed to training. Have you done the math on that, Jonathan? How much inference does the world need?
It's insatiable for the reason that, unlike with the industrial age, where as you're producing oil, and compute is the new oil, let's be clear about that, you could only consume as much oil as you had hardware built that could consume it. In the generative age, every model that you train, you can scale it up to the amount of compute that you have available. As such, people are scaling as much as they can possibly get compute.
And so that compute needs data center capacity. Where do you add that? How much? Is it the US or internationally focused, Jonathan?
Actually, that's one of our primary advantages. So the GPUs that are being deployed today often need liquid cooling, and those are new data centers. In our case, we're deployed in North America, so the United States, Canada. We've deployed in Europe. We've deployed in the Middle East. Our first deployment in Europe was actually an air-cooled data center that one of the hyperscalers was moving out of because they couldn't put GPUs into it. Because we use so much less energy for our chips, because we produce so much less heat, we were able to take that data center on. And so that gives us this ability to get access to data center capacity in a very competitive way.
So the language processing unit, the LPU that you offer, I mean, you're taking on the TPU that you helped design over at Google, we understand, and indeed Nvidia. Technically speaking, how is it achieving this, the run rate that you can get at a lower temperature point?
Yeah, so the architecture is very different. And I took a page out of what I learned at Google with respect to distributed systems. Everyone knows that Moore's law means that the number of transistors doubles roughly every 18 to 24 months. What I think not so many people have noticed is that the number of chips is more than doubling every 18 to 24 months. So we asked ourselves, if we were going to be increasing the number of chips, was there an architectural change that we could do? And the answer was yes. And so without getting into the technical detail, what we do is we take the models, the AI models, and we spread them out across a large number of chips. And that allows us to operate much like an automotive factory. And the more chips that we use, the cheaper it gets, the faster it gets. And our advantage is how many chips we can bring to bear on an inference problem. Now, typically, when you're talking about a training cluster, you'll talk about 16,000, 32,000, 64,000 GPUs. And the more GPUs that you can bring to bear, the better. That hasn't been the case in inference. Typically, you'll see 8 GPUs, and it's just a technological limitation that prevents you from bringing more. In our case, we're running some models for inference with 4,000 or more chips, and the more chips that we can bring to bear, the faster and the cheaper it gets.
Jonathan, has Groq signed any deals that would see you benefit from the commitments we've had in the last 24 hours in the United Kingdom at the hyperscaler level, and also some of the AI names that have committed tens of billions of capital to that market?
Yeah, so Groq has deployed some large clusters around the world. As an example, in the Middle East. And so we worked with Commerce to be able to get that deployment done, and they were very helpful, and we appreciate that. And also in Finland. Of course, we're looking at the UK very closely, and I'll actually be there in less than a week.
The world right now is GPUs and XPUs, or in your case, LPUs. Why do we need both?
The architectures are quite different, and they have different bottlenecks. No architecture is perfect, right? This is why we don't use CPUs anymore for AI. We use predominantly GPUs and now LPUs. The difference between the two is that GPUs are very good at parallel processing. That is, if there's no sequential component to it. But when you're talking about language or other reasoning or logic problems, you can't produce what's called a token. You can't produce the 100th token until you've produced the 99th, or you can't produce the 100th word until you've produced the 99th. And that brings in a sequential component. Yeah. Now, CPUs have been good at sequential, but these problems also have a parallel component at the same time. What the LPU does is it's really good when you have both a lot of parallel and a lot of sequential components to the problem. And that allows us to output tokens at a very fast rate. And the experience difference, it's the difference between broadband and dial-up, but at the much lower cost than you would expect given the speed.
Jonathan Ross, CEO and founder of Groq, on their latest fundraise. We thank you for joining us today. Meanwhile, coming up, what to anticipate from this year's Meta Connect event, kicking off later today. From New York, from San Francisco, this is Bloomberg Tech.
Welcome back to Bloomberg Tech. I'm going back to semiconductors. We talked in the show about how Nvidia shares are under pressure. Well, at the index level, they're putting a drag on the SOX, or Philadelphia Semiconductor Index. Over the course of 10 sessions, you're up 8.2%. But actually, as of last night's close, the SOX had its best streak of gains since 2017. As it stands, that streak's over. We're down 0.4% in the session. So we've gone from a story where we had AI-fueled growth on chips. Now we're getting concerned about China in particular, and over the next few days, we should hear more because Jensen Huang, the CEO of Nvidia, is in the United Kingdom with President Trump. And Nvidia is at the heart of these negotiations between the US and China. It's an index to watch going forward, but it has seen a lot of momentum of late. Kara.
It has. Someone who's not in the UK is Mark Zuckerberg. Why? Because Meta Connect is kicking off later today. Analysts are anxiously watching for any groundbreaking announcement, like, well, maybe some smart glasses project. Brad Erickson, internet analyst at RBC Capital Markets, joins us now. Smart glasses has been where it's at from a hardware perspective for Meta. How can they push that story forward?
Yeah, I think it's just integrating more of the capability with Mark's vision on Meta AI, right? Like, they've given some applications in terms of some of the translation capabilities, being able to, have some of the augmented reality capabilities. And I think you'll just see, we expect to see more of that tonight. So
really, the vision of generative AI coming at the heart and why Meta AI is really amplified with the hardware story. But the competition's coming. We know Google's got them in the works. We know that, of course, Apple might or might not in the future. But Brad, therefore, what sets their deal with Ray-Ban apart? How can they continue to offer a little bit more to the experience than an augmented reality vibe?
Yeah, it's always going to come down to the same things that arguably made Apple so successful over the last, nearly 20 years, which is tight integration of hardware and software, right? Meta has the platform that people already know it for the various family of apps. They've created Meta AI, have more than 1 billion users. The utility that creates and the stickiness that creates for their customers, that's going to be the key thing. The hardware, everybody's going to be able to do, right? Just like they've always been with any piece of consumer electronics hardware. It's the software that's going to keep people coming back if they're going to come back.
Brad, thank you for bringing up Apple, and you also referenced translation. Last week at the iPhone event, Apple shares swung from a decline to positive territory, and Duolingo shares plunged when Apple demonstrated simultaneous translation through the AirPods Pro 3. A year ago, Meta demonstrated simultaneous translation through that generation of Ray-Ban Metas. Why did Meta not get the same credit for that technology that Apple did a week ago?
Yeah, I think part of it is just it was so new, secondarily, just relative to the stock. You've also got a giant core business, right, that you're comping, and that's clearly not going to be the focus of it, nor is it necessarily clear how you would yield an advertising business out of that. So I think that's just mechanically, that's kind of the primary reason. But clearly, this is going to be a capability for a lot of companies here going forward, and certainly could be a super cool complement as, again, Meta looks to build in all these capabilities to these new glasses.
A lot of people still don't understand the Meta AI story. With ChatGPT, I just have an app on my phone or on my MacBook. I use it every single day, right? With Meta, I have a standalone app. It's integrated into Instagram, WhatsApp. I am an owner of the Ray-Ban Metas, a different interface or medium to use it. But do you see kind of what the end thing is going to be for Meta? How consumers actually interact with the work they've done on the model side?
I don't think anybody does, candidly. I think one of the things that I'm always struck by as we all study and learn AI every day is that, week by week, month by month, we kind of all have to expand our minds on what the capability is. Vibe coding is a great example, something we've been spending a lot of time in lately with the web design companies. People are using these things to develop applications, not to build businesses necessarily in the traditional sense. That's where everybody's brain would have gone. But they're creating daily productivity tools. Enterprises are using them to create actual internal work processes, right? Unrelated to their core software. So there's all sorts of new things. I think Meta AI is very similar in that, we know that it's going to be able to provide, like you said, ChatGPT functionality with the app. What we don't know is how else might people build that into their day-to-day lives, whether it's for work, personal, or productivity, or what have you, that's going to be value add and get to a point where you're going to say, hey, I can't live without this new capability in my life. And we don't exactly know what that is yet. We're learning about it. We're trying to sort of expand our minds, but we haven't gotten there yet.
Well, I mean, Mark Zuckerberg's been expanding the amount that he wants to spend on it and the appetite and ambition, that's for sure, Brad. And he's been given a pass. And you think the stock could climb even higher, up to 850, another 9% gain on where we currently are. How much does the TikTok story bear into its bread and butter right now?
It matters, but TikTok is a very small business compared to the size of Meta's overall ad business. I will say that, for a quarter or two now in our channel checks, talking with advertisers, what we have heard was, the stalled or the uncertain future of TikTok had really caused advertisers to pause any spending growth. They're still spending, to be clear, on ads on TikTok, but there wasn't nearly as much growth. To the degree that we get a deal here at some point, maybe that provides clarity, becomes a little bit of a headwind, but I don't want to overstate it, because TikTok's still, somewhere in the, call it 10% of the business relative to the size of Meta's ad business.
Brad Erickson of RBC Capital Markets, thank you very much. Now, coming up, Lyft CEO David Risher joins us to talk about the company's new partnership with Waymo in Nashville that's coming next year. The The stock is having a severe and big upwards reaction to this. We'll discuss it. This is Bloomberg Tech. Lyft and Waymo are partnering to bring self-driving taxis to Nashville. Customers will be able to request driverless rides on both companies' platforms, and Lyft will provide fleet management for Waymo's Nashville operations. Let's get to more with Lyft CEO David Risher. This is something you've been working on for some time.
That's right.
And the state of play is very clear. Waymo also has a partnership with Uber in different markets.
Yep.
You now have a partnership in Nashville.
Yep.
Just explain the rationale for you on why this is a great go-to-market for robotaxi.
Well, as you know, we've been saying for a while, we think self-driving cars are going to be hugely market expanding for rideshare. It's a really good product. And then when we looked at potential partners, of course, Waymo, has to be at the top of the list. The great thing about this partnership is it does two things. It supplies demand. So if you're in the self-driving car business, you got to have demand, and we got lots of demand every single day, and we do it in a very integrated way. But the other thing is, as you just mentioned, it supplies fleet management. And that sounds kind of geeky, but it's really important that every one of those cars be ready to drive, 24/7 if needed. And that's something we're really good at. We've been doing that for a long time.
So you're emphasizing the sort of capital light business model for you, right? The counter argument is the Tesla or the Zoox one, which is control the full stack,
right.
Hardware, software, operationally, the app the consumer interfaces with. Yeah. Would you argue that you can scale this faster going this route, go to more cities quicker?
I would, yeah. I mean, this allows every company to specialize, right? So Waymo can really focus on providing great self-driving technology. The Waymo Driver is obviously a great product. They partner with OEMs, the car manufacturers, that can choose the best, car for them. And then we can provide the fleet management, as I say, that keeps the cars clean and charged and ready to go, as well as the demand, so that anytime a person wants a car, they can get one, or they can get a driver car, right? I mean, they can get both. So I think it's a great division of labor.
Let's talk about that fleet management, Flex Drive, because you're going to be building, you're going to be putting some capital expenditure to work, David. Yeah. Why does that make sense, and when will that be finished?
So we've been in the Flex Drive world. Let me explain for a second. So about a decade ago, Lyft decided that for a certain type of driver, it really makes sense to have cars that they can rent right on the platform. And they can we can take care of the maintenance and making sure that those cars are always ready to drive. So that's what we've been doing for about a decade now. So when we look at the autonomous vehicle world, look, when you see a car driving around the city, it looks like magic. It looks like no one had to touch it. But no, someone had to charge it. Someone had to clean it. Someone has to maintain it. Someone probably has to reboot it from time to time. And we're really good at that. So as you say, we're building a new depot there. We've got a small one. We're building a bigger one for this partnership. And what it does is it allows the cars to be ready to drive, Think about, so when you travel on an airline, and you know that, of course, they want the airplane in the air, but they also need it to be ready to fly at all times. They want that turnaround to be super fast, and that's what FlexDrive does. It means that people like Waymo can get the most out of their asset, which is super good for them.
Look, today, investors love this announcement, and the shares are rising. Shares have been doing well all year because you've had 3 straight quarters of profitability. David, how are you going to finance what is a little less asset light, is building these facilities to help keep all our auto cars clean?
Yeah. So as I say, because we've been in the FlexDrive business, the subsidiary business, for a long time, we've actually had capital deployed to that for a long time. We have about 24 locations in about 15 different states across the United States, which I think gives you a sense of how this kind of partnership could scale over time. And we own some of those cars ourselves. Others of those cars are financed by other groups. So the good news is this won't be a significant change to the current strategy. It's just sort of a revectoring, let's say, of the money we spend more towards autonomous.
Okay, scale over time. This morning, Bloomberg Tech producer Marguerite Gallerini put this table together. You know the table, right? It explains the roadmap from here. So let's look at it together. This is 2026, and it focuses on Waymo principally, but there's you there, right? Nashville.
Yeah.
You are going to come up against Uber in negotiating with Waymo for cities that are not yet claimed for. What are the advantages that you're going to present to win that business with Waymo against Uber? And how much are you going to have to give up, to get a deal done?
Yeah. So I think the way I would look at that is one of the reasons we were so, I'll call it patient in working through this deal, because it took a while, we wanted to come up with something that is good for Waymo, good for Lyft, and good for riders. And that's hard to do. It's hard to have, kind of a three-way win. We feel really good about it and feel like this is a great model for us to expand to other cities in the future. But look, city by city, some places we're actually going to compete with Waymo itself, right? Because, for example, here in San Francisco, they've got their own
Appreciate
app.
that admission, yeah.
Of course. So this is something that we have to kind of recognize and say, how do we come up with a construct that is really durable and, frankly, can benefit all the companies? And then the other guys will do what they do, and, we'll see who does a better job.
Look, people are going to accuse me of wanting to create a headline here, but it's a really important question. Yeah. Tesla and Zoox are committed to their own go-to-market model, right? We talked about they control the full stack. Yeah. But have you held discussions with both Tesla and Zoox to say, look, this is the model we're doing with Waymo. We can do something similar. Do you see that as being realistic?
So, of course, I don't want to comment on conversations we might be having. What I can tell you is we're talking to everyone who finds the partnership model interesting. So there are, of course, always companies, whenever you see a new industry, you have some companies that say, I want to do it all. And frankly, if you look back a couple of years ago, just about every company in the self-driving space was in that zone. They wanted to do everything, top to bottom. I think over time, most companies find, particularly when it's capital intensive and quite complex, like rideshare is and self-driving is, that a division of labor where everyone does what they're good at is the best model. But we'll see. Yeah. It's still such early days.
But you struck deals with interesting players in Europe, Baidu. What's it like working with a Chinese giant? What were those negotiations like?
That actually, I'll tell you what was very interesting. It came together fairly quickly. And in part, I think is, frankly, Chinese companies are kind of built for speed. They, for those of you who don't know, Baidu, you can sort of think of them as kind of the Google or Alphabet of China. They have many businesses, but self-driving cars are a very important one for them. And we committed that we would roll out some of their technology in 1 to 2 markets we would expect in Europe over the next 12 months or so. It's still very early days there, but I can tell you they've got really high standards for their technology. We're super excited about working with those guys, and we'll have more to say about that next year once we start to roll out in Europe.
1 minute. How hard is it to get to New York?
I mean, I can take a flight there pretty easily.
but the auto, the robo-taxi, how hard? When am I going to have it here?
I love that. It's going to take a little while. New York is a complex place to do business. The streets are complicated. There's a lot of interest there. Look, this, Caroline. I mean, Lyft has been there for many years. It's super strong in New York. We also run the City Bike program, as you know. Super excited to bring self-driving there someday. But that was probably going to take a little while. Sorry about that. You're going to have to wait for a little while.
My addiction with the bikes will just have to continue. Lyft CEO David Richter.
There we go.
It's always a joy to have you on the show. Take care. Meanwhile, coming up.
Thanks so much.
The global data center build out, it is hitting maybe unsurprising records, of course, thanks to this AI boom. What does that mean from a construction standpoint? We've got the perfect CEO on next from procurement platform Kojo. This is Bloomberg Tech.
Mentioned earlier in the show that Microsoft will invest $30 billion in the UK as part of a push to expand AI infrastructure. We also heard from Groq about its data center plans. Of course, tech companies are pledging to build more data center capacity around the world. Let's bring in Maria Davidson, CEO of Kojo. It's the largest construction procurement platform in the US, giving her a unique insight into the data center build out. I think we can get to where you fit into the process of what is just massive infrastructure as a project. But your reaction first to what's happening in the UK, it seems to be the next market in this AI cycle.
Oh, absolutely. I mean, when you think about how much potential there is in the UK, I think it is extremely exciting and very, very untapped. So I love to see companies like Microsoft and Google coming in and investing in the UK, and the US and the UK actually working closer together.
You say a lot of potential in the UK. Why?
I think because, one, there's extremely talented workforce in the UK, and you have world-class universities, you have incredible research like DeepMind coming out years before anyone would have expected an outcome like that in the UK. And so I think that means that in the UK right now, if we keep on investing, I think we're going to see a lot more DeepMind-like outcomes.
I've got to say, you've got 3 Brits around a table talking about the opportunity in the UK, so I'll diverse us a little bit because we're 3 Brits that sit in the US right now, Maria, and you're building businesses to try and make supply chains clearer for contractors, for builders out there. And I'm interested as to what the scale is like here in the United States and what the key bottlenecks are that you're trying to fix.
I mean, the scale is enormous. So just this year, we have $40 billion going into the construction of data centers in the US. That's expected to grow more than 10% a year. So by 2030, that's going to be $65 billion. That's unprecedented. And the biggest issue with building these, it's not getting GPUs. It's getting the materials and finding the electricians to be able to actually meet this demand.
Okay, so your role is ensuring that when the contractor, which is very hard to come by and labor is short and we've seen immigration policies hit that, but when you get them on site, they've actually got the pieces and the parts to work with. What has been some of the most complex areas when it comes to particularly the hyperscalers need and the data center build out?
It's a lot. When you think about the construction industry in the US, even though they're building some of the most sophisticated infrastructure out there, right, they're building projects that involve huge amounts of technology and AI infrastructure specific needs, they still largely have to rely on pen and paper and Excel to track where things are. It's hard to know what's arriving when, right? These are all huge challenges. And so when you couple that with the fact that there are 500,000 workers missing from the US construction workforce, and you couple that with the fact that materials on average are 44% more expensive than they were in February 2020 before COVID, that starts really creating a perfect storm.
I actually think it's worth going a step earlier in the process than what Caroline just asked about, right? We've kind of learned over the course of the last 2 or 3 years about how it works in the United States. You have a financing partner, you have someone like Crusoe putting it all together. You need to select a site. Then you've got to talk to the utility because you need to power that site. The utility has to think about where they get the electricity from. Is that going smoothly and well, that initial process?
It depends. It's definitely gotten a lot faster. If you think about your average size data centers, right, or data centers on the smaller side, maybe 10 to 30 megawatts.
Right.
Those previously would have taken, let's say, 24 months to 36 months to build. Now you're seeing data centers built probably twice as fast, in part because things like site readiness, interconnection, they're all being dealt with in advance. Now, I think prefab is a huge subject here, because the more that we can lean into modular construction, the more we don't have to rely on the sequential building, but we can actually build in parallel.
And there's also like a self-fulfilling prophecy in the sense that all of the AI names who actually just end up leasing the capacity, right? They don't even own the thing, but they would say, oh, all the work we're doing in AI is actually going to benefit the planning and execution of these build-outs. I guess that's what you'd say you also help with.
Yeah, absolutely. I mean, a lot of it is the better planned that you can be in advance, the better the project is actually going to go. And so if you know all of the components that you're going to need, if you have the mapped out schema, if you have all of those interconnection blocks ready to go, then, of course, contractors can be much better prepared.
I want to talk about you, about Kojo, about what the $94 million you've thus far raised, 600 construction companies that you're working with. You've just had an add-on to your Series C, I believe. How much are you seeing inbound? How much are you fighting off people wanting to put money into your company because they're realizing it's about bricks and mortar, it's about the very underlying infrastructure right now?
Well, we're seeing a huge amount of inbound. The focus for us has always been, how can we empower contractors, right? How can we take the contractors that for a really long time were completely ignored by the tech industry? And specifically there, I'm talking about the trades, right? The electricians, the folks working in mechanical and HVAC and drywall. They, for a very long time, had very few solutions that were built specifically for them. And so for us, it's about saying, well, how do we build solutions that are specifically targeted towards you and that solve your biggest pain points, like knowing where your materials are and having the visibility of how you're doing against your estimates in real time? Well,
you're just completing a $10 million Series C extension. Come back when you're raising yet more, I'm sure. Maria Davidson, CEO of Kojo. It's great to have you on the show. Meanwhile, that does it for this edition of Bloomberg Tech. We've done a whole host of things, Ed, but we're going to count down to Meta Connect tonight. Of course, tune in tomorrow for an interview with Meta's Chief Product Officer, Chris Cox, live on the show tomorrow, which, Ed, you'll be doing?
Yeah, looking forward to that. I have a lot of questions about the relationship between software and hardware. After all, that is technology. Check out the pod. You know where to find it. On the Bloomberg terminal, as well as online on Apple, Spotify, iHeart, and all kinds of other places on the internet. Thank you for watching. This is Bloomberg Tech.